And then what happens in January?
We'll wait till after the election.
Yeah.
You know that's going to be what happens. On November 4th, no one will ever have heard of coronavirus. It's true. It's wild to me. Even my building, like, the jacuzzi's not open, but, like, the gym is open and the pool's open. And I was like, when can I go in the hot tub? And she's like, well, we're thinking, like, middle November, like, second week. And I'm like, wait, why? Like, what is that?
Is it indoor or outdoor?
It's outdoor. But I guess, like, the heat or something.
The acid's open.
Huh?
The acid is open.
No, it's everything's
Acid's open.
The acid's open in our.
Oh, yeah. It's, I don't know why for us it's closed. The pool is open.
Yeah, the pool is open.
The jacuzzi is closed. But people go there. It's not silly.
All right, I've got 8 o'clock. Obviously, we're missing quite a few people, so I'm going to wait another couple of minutes. But while I'm waiting, those of you out there in Zoom land, I sent you a quick announcement / file this morning that you can download, that you will need to download. Specifically, it is a one-page cash flow statement. So if you haven't downloaded it yet, go ahead and download it, probably print it off, or at least have it somewhere available that you can kind of look at it. All right, so we've got 3 people here in the room. We've got 1, 2, 3, 4, 5, 6, 7. So basically we've got 10 out of 25. Okay.
What, 10 out of 25?
Yeah.
He likes that first quiz.
What?
Damn, Dr. Forgy, why are you scaring students away?
I don't know. I mean, all I can say is that first quiz, people, I mean, I think I had at least a half a dozen people that got perfect scores, and then several that got 9s and several that got 8s. Only a few people did not do well, so I don't know. Okay, well, I'm going to go ahead and get started. I mean, I'm sure other people are going to be joining us here any minute now, but that's okay. All right, so today is predominantly focused on sort of cash flow for commercial real estate properties. Now, those of you that have had me for the real estate finance course, what we did, and we'll go ahead and do it kind of again, is sort of an abbreviated version of sort of a real estate pro forma. But what I have provided you with today is a little bit more expansive in the sense of this is kind of what your textbook uses as in terms of getting into things like reimbursable expenses, non-reimbursable expenses, and then also other things that potentially affect the actual cash flow from a real estate property. So let's just sort of start out with an example And let's say that we've got two properties in our portfolio, property A and property B. And let's say that property A has 30,000 square feet of space.
Dr. Forgay, I don't think you're projecting your whiteboard.
Are you sure?
Man, I don't see it.
It's usually 2 screens.
Anybody else?
Yeah, same. I was.
I was just about to say.
Interesting. Okay. Well, I did the same thing I've done previously. Let me see if it, hold on. That's weird. Happened to the Zoom.
See, on this one there, you need to put a video on where it says Dr. Fred
Yeah, it's
Foggy.
usually 2 screens for some reason for you. Like it's like the white.
Well, yeah, because I'm using two screens.
Oh.
So, but the one, it doesn't show the picture.
Apparently it signed me out or something. Okay.
They click on this Dr. Fred Foggy and make the picture.
Let's try. All right, is it working now?
Yes.
Okay,
Yep.
sorry about that. All right, let's see here. Go back to where this thing was. Okay. All right. So once again, we've got one property that's got 30,000 square feet of space. We've got another property, property B, with let's say 20,000 square feet of space. Obviously for a total of 50,000. Now, each of these properties we're going to lease out, and let's say that we lease out the 30,000 square feet at $25 per square foot per year, and we lease out the other one at, let's say, $35 per square foot per year. Okay, so go ahead and calculate what our income is off of both of those, and while you're doing that, I'm going to adjust the screen over here so I can see everybody. Oh, there we go. Okay, so as we do this, let's see what we get. All right, so 30,000 square feet of space times $25 a square foot. That's going to be $750,000 a year, okay? And then the 20,000 square foot times $35 a square foot, it's going to give us $700,000 per year. So the total, $1,450,000 per year. Okay? Everybody good with that? Yes? Okay. Now, this is where we're going to start with our little sheet. Okay? Once again, those of you that kind of came in a couple of minutes late, go to the announcements, download and print out the cash flow statement handout. And for year one, what we're in essence doing is we're going to say that under the rental income specifically, our gross potential rental revenue, okay, or as we have previously sort of called it, gross potential income, or potential gross income, is going to be this $1,450,000. Okay, now once again, those of you that have had me before, once again, I typically call it potential gross income. Let me erase this here. But what you're going to find, obviously, is you look at different textbooks, you look at different software packages, you look at, just different people and kind of how they refer to something. Ever so often, there are these little nuanced differences in what they may refer to something. In this particular instance, your textbook author calls it the gross potential rental revenue, okay? But it's the same thing, okay? So, in this case, we've got $1,450,000 of the potential gross income or gross potential rental revenue. And then from that, we're going to have vacancies, okay? And so in this case, now what I tend to do in a lot of cases is take vacancies and then lump them together with collection losses. Your textbook author separates them out, okay? So in this case, we're just looking at vacancies. Now, this brings up the question, okay, what is the difference between a vacancy and a collection loss? A vacancy would be what? It's empty, therefore you're not receiving revenue. Whereas a collection loss is somebody's there, but they're not paying their rent. So one would expect in this, horrible pandemic, what do you think you're probably going to see a lot of? Collection losses, okay? More so than necessarily just vacancies, all right? All right, so in this case, let's assume that we have a vacancy of 10%, okay, for this property, all right? So in this case, vacancy, 10% of the gross potential rental revenue. So that's just simply going to be taking that number, multiplying it by 10%, and you're going to end up with 145,000. Okay. Everybody with me still? Yes? Okay. Then, this is going to give what your textbook author refers to as your net base rental revenue. All right? So you're going to simply subtract out that vacancy, and you end up with $1,305,000. All right? Everybody with me on that? Now, what would probably be a good idea for you here and those of you out there in Zoom land is on this form is to probably notate out in the margins what you're going to be adding, what you're going to be subtracting, okay? Just so that you don't get flubbed up whenever it comes time to actually go through and do a quiz and do the calculations, okay? All right, so the next item is going to be to add in percentage rents, okay? Now, as we talked about last week, the whole idea of percentage rents, assuming these are sort of retail properties, is that we're going to be collecting some sort of an additional rent on top of the base rent that ordinarily is going to be based on sales per square feet or some other or overall gross sales, that sort of thing. But here I'm just going to probably either just give you that number, or let's just say we'll keep it relatively simple, and let's just say the percentage rent is going to be equal to $3 per square foot per year, okay? So in this case, what that's going to be is you've got 50,000 square feet of total space, and we're simply going to multiply that by 3, and that's going to give us $150,000 that will be our percentage rents. Now this is obviously adding to our income, so I'm just going to put a little plus sign there, all right? So now the new total rental revenue is going to be $1,455,000. Okay? Everybody good up to this point? Okay. Now, if you want to sort of think about it, just the mindset of how this little section of this basically cash flow statement, the way to sort of think about it, this is all about revenue generation from some form of rental income and the adjustments for vacancy, okay? Simply put. This next little section is going to deal with other forms of income, but these specifically are going to be what are referred to as expense reimbursements. Okay? Now, those of you that are taking like the Argus class, one of the things that you will have to deal with, or should have to deal with there, are issues of expense reimbursements, okay? Which is, in essence, you, as the property owner, are receiving these dollars from your tenants for these expenses, okay? But yet, you, as the property owner, still are having to write a check to someone for these expenses. Thus, they are reimbursable to you. Okay, does that make sense? All right, so in this case, for the purposes of our little analysis here, we've got two different types of expense reimbursements. One are common area maintenance billings. Now, if you remember from our discussion last week, when we talked about common area maintenance and that sort of thing, or CAM charges, this is where over the year, the property owner is going to have all of these ancillary items that they're going to charge you for. But once again, from the purpose of the property owner, this is obviously whose income statement or cash flow statement that we're working on is from the owner's perspective. Whatever they charge you, you're going to be paying that as the tenant, but yet the property owner still has expenses that are going to be outgoing associated with those. Okay? And that's going to become a little bit more clear here in a minute when we get into the actual expense side. Okay? So once again, trying to simplify kind of the calculations on these, let's assume that your common area maintenance billings are going to be $2 per square foot per year. So in this case, $2 a square foot times $50,000, or I'm sorry, times 50,000 square feet is going to be $100,000. All right. And then property taxes, okay? So, once again...
Is it minus or plus now?
Well, in this case, it's plus, okay? And the reason is because this is money you are receiving from your tenants to basically pay for these items. And this is where I'm saying it could get, a little bit counterintuitive at first, but it will make sense once we kind of get a little deeper into this, okay? So you are going to be, in essence, invoicing your tenants $100,000 for those common area maintenance charges. Okay, that's just why it's income to you as the property owner. All right, you're also going to be invoicing them for property tax. Okay, now property tax, this is, the first time people see some of this stuff, they tend to sort of mix and mingle different kinds of ideas and concepts, and property taxes are not the same as income taxes, federal income taxes. Property taxes are local. property taxes basically are assessed by, typically you've got a city government, you've got a county government, you've got a school district, you may have a water district, you may have a flood district, you may have, in some instances, every single piece of real estate may have, at a minimum, of 3 to 5 individual districts that typically roll up into some sort of a central appraisal district. And I have seen in some cities, in some particular properties, you may have as many as 10 different distinctive taxing authorities, okay? Because they break it out maybe into like a junior college or community college district or a hospital district or a whatever, that they want to sort of, instead of wrapping it up in some sort of umbrella of just city, county, and school district taxes, they may want to separate it out into broader and broader categories. But the point being is property taxes are local, okay? And those local taxes really have nothing to do with your federal income tax, with the exception of, yeah, you get to write them off as a deduction, okay? But outside of that, there's really no connection between local property taxes and federal income tax, okay? Which we're going to be getting into a little bit later today. All right, so your property taxes, let's just say, once again, to kind of keep things relatively straightforward, and this is probably way too low of a number, but I just kind of trying to keep the calculation simple. Let's just say it's $1 per square foot times 50,000 square feet, or $50,000 that you are going to get reimbursed by your tenants, okay? Then we have one more little line item here. Ancillary income, which I typically would refer to as just simply other income. Same concept, all right? And in this case, let's also say it's like $1 per square foot. So another $50,000. All right? So in this case, what we're going to do is we're going to take the total rental revenue number and we're going to add in these three basically items. The first two of which are the reimbursable expenses and then other income, once again for like a retail property. This could be parking fees, could be anything else that maybe they have on the property that generates some form of income from the property that's not necessarily tied to the actual space that's being rented out, okay? So when we do this, we're going to end up with our gross income, or what they're referring to as our gross income. All right? So in essence, we've got the $1,455,000 plus a total, looks like, of $200,000 of these other items of income. So we end up with $1,655,000 as our gross income. Okay? Everybody still with me?
This is all one continuous.
Yes. Once again, for those of you that maybe have come in a little bit late, what we're doing is we're working through the cash flow statement that I sent you via announcement today in Canvas. So if you haven't printed that out, you probably are going to need it, okay? All right. So once we get down to gross income, now this is where your textbook then subtracts out credit loss. And in this case, I'm kind of just doing this on purpose, just so that the numbers are easier to work with. I'm going to say that your credit loss is $55,000. So that's going to leave us with a nice 1.6 million as our total operating income. Now, once again, this is the same exact thing as what I typically have referred to as what? Your effective gross income. Okay? In other words, whenever I keep referring, those of you that are new, whenever I keep referring to what I normally sort of describe, normally I tend to sort of say, okay, we've got potential gross income, we subtract out vacancies and collection losses, we add in other income, and that in essence gives us effective gross income. But what your textbook author is doing is basically expanding that relatively simple sort of calculation into something a bit more complex to sort of isolate what some of these items are in more detail. Okay, that's all that's really happening. And now one of the things that, as I sort of said, if you're taking the Argus course, what you are probably seeing is even more detail as to what those items can be on the income side, as well as certainly on the expense side. Okay? So that gets us down to what, once again, your textbook author is referring to as total operating income, or I would ordinarily just call it effective gross income. Okay? Everybody cool up to this point? Yes? All right. Now, this is where it hopefully begins to make a bit more sense. Okay? Because now under the operating expenses, or OPEX for short, what we've got, and so, okay, let me kind of back up here a second. So once again, in my short version of kind of the income statement, effective gross income is followed by subtracting out total operating expenses, and that gets us down to net operating income. Okay? So this whole piece that we're about to do is really all about the total operating expense portion. Okay? So for those of you kind of trying to find a reference point. All right, so in this case, what we've got are reimbursables, but this is the expense side, okay? And for the most part, this should match up with what we have above. So in other words, this is the part of where we, as the property owner, now are writing a check to whoever with respect to paying for the individual items within the common area maintenance. So for example, let's assume that we had landscaping done, okay? Or we had basically cleaning services, or all of these things would ordinarily be included in common area maintenance. This is where we, as the owner of the property, are in essence writing checks for those items. Now, hopefully, we did a good job of collecting common area maintenance reimbursables from our tenants to be able to pay for these. So what you should have happen is you should be able to simply kind of bring down the number that you had in common area maintenance billings and place it now as an expense. Okay? Does that make sense to everybody? Yes or no? In other words, the revenue up here from the common area maintenance billings, that's coming from the tenants. That is revenue we are receiving from the tenants. But yet, we, as the owner, have to actually pay for these expenses, like landscaping, like sort of once again, general maintenance, sort of repairs, that sort of thing. And so how we are paying for it is out of this common area maintenance sort of account. Okay, so for the most part, this should be pretty much a dollar for dollar matchup. Okay, now is it possible that they don't match up? Sure, you know, that we overcharge or that we undercharge for those common area maintenance items. Okay, but in theory, they should match up. Okay, does that make sense? Yes or no?
Yes.
Okay. Then we have our property taxes. Now this
I
one,
have a question for these property taxes. Is this for commercial or for, do people charge for property taxes in residential?
yes, property taxes are charged for every single parcel of real estate unless it is a tax exempt parcel of real estate. And what I mean by that, like churches don't pay property taxes. Non-profit organizations, like for example, Nova, you know, by virtue of being a non-profit university, does not pay property taxes.
Crazy.
Okay? State universities,
No, I
you know, so like FIU,
in residential, does the landlord in residential charge the tenant for property taxes?
what happens in residential, like for example, let's say that you're an apartment complex, okay, owner. So I own, let's say, a 100-unit apartment complex. What I will do, or will, you know, I mean, obviously I just simply charge you rent, but in that case, I don't seek these items as reimbursable expenses. When I seek them, I simply seek a overall dollar amount in rent. Part of that rent naturally is going to pay for the property taxes associated with the property, okay? But it's not a situation of where I am billing the tenant for their proportion of the property taxes and then ultimately using that billing to pay for the property taxes. The reason why in commercial and industrial space this kind of gets isolated is this is all about, in essence, trying to be transparent, okay, to the tenants, and this is all also about with the whole idea of net leases versus gross leases. With a net lease, the tenant is going to be responsible for the payment of those property taxes. And so therefore, what is typically going to happen, much like we're sort of demonstrating here, is the property tax bill is going to come from the local government, local taxing authority, and it's going to be, let's say, $50,000. And I, as the property owner, because the property is in my name, I, as the property owner, am going to write a check to the local government authority for that $50,000. But what I'm going to then do is sort of pass along, in essence, the property tax statement to you as the tenant and say, hey, I just paid the $50,000 in property taxes. Now you are responsible for reimbursing me for that $50,000. Thus, where the reimbursable piece of this comes in up here, okay? I pay the bill, but yet you're reimbursing me for it. Okay, does that make sense, everybody, out in Zoom land? Yes? Okay.
Is this the same way that a property is accounted for?
What do you mean?
Like by the books. Like if you're doing like literally like a property level accounting for a property.
To a certain extent, yeah, because what we're doing here, this is what is referred to as a cash flow statement. So it's more about cash in, cash out, okay? Now, you know, in terms of this being like an audited kind of financial statement, not necessarily. This is more just simply saying, here's the income we're receiving, here are the expenses we have, here's, you know, what's sort of left over at the end of the day. But what we're going to begin to see, starting today, is how not just property taxes influence things, but how federal income tax impacts things as well. And we're going to get into depreciation and all that sort of stuff, okay? Okay, so here we've gone through, we've got our $150,000 in reimbursable expenses. Then you'll see right below that are the non-reimbursable expenses. So what this means, these items, for whatever reason, we are not charging these directly to the tenants, okay? Or at least not seeking a direct reimbursement from the tenants for these. We still have to pay for them, and we're going to be paying for them with rental money, but in terms of getting a specific reimbursement from the tenants for these items, we are not doing so. So in this case, those three items are insurance on the property, utilities, and management fees, okay? Now, it's also possible, once again, this is where I'm purposely not trying to make this more complicated than what it needs to be, but it's possible that like your common area maintenance charges could be inflated. And part of the reason they might be inflated would be to actually cover some of these non-reimbursable expenses. I didn't do that on this example, but that is potentially a possibility, okay? So in this case, once again, to kind of try to keep things reasonably simple, the insurance charge I'm putting is $1 per square foot, so that's going to be $50,000. Utilities, I'm going to put as $1.50, so that's going to be $75,000 for utilities, and then management fee, I'm going to put as $50,000. I think all of those are really low, probably way too low, but nonetheless, I'm just trying to go through and provide, obviously, a calculated example. Now, what you're going to do is you're going to take those items and you're going to add them up, and that's going to be your total operating expenses.
Professor, for the utilities, just out of curiosity, you had kind of mentioned it with the CAM charge. We could do a pro rata share of
Yes.
a portion of the utilities.
Yes,
would it be considered a reimbursable expense if you would do something like that?
It could be, absolutely.
Okay.
You know, or see, also what could be basically made as an assumption within this is that this line item for utilities could be, once again, just common area utilities, or maybe just utilities for like an on-site management office or that sort of thing, because, you know, most tenants, I mean, once again, depending on the property, that's where it always gets a little bit confusing, but most tenants are going to be separately metered for electricity, maybe in for water and gas if they have it, and so forth, so on. So they're going to have a direct relationship with the utility company to actually pay their individual utilities as a tenant. So this line item may be for utility expenses just for components of the property, like I said, that are sort of common, you know, to the property as a whole, as opposed to individual tenants within the property, okay? But that's also, I mean, you know, and this is where, you know, it starts to get really into the weeds on some of this, because obviously utilities can be a huge expense. And, you know, who pays for that, as we were sort of talking about last week, matters, you know? And, you know, you don't want to sort of just gloss over, okay, well, I'm responsible for utilities as the tenant, I'm responsible for this as a tenant, you know, the next thing you know, I mean, from the property owner's perspective, they'd have to make you responsible for everything. okay? You know, because for all intents and purposes, as a property owner, what do I really, truly want as a property owner? I want mailbox money. I want people mailing me a check every month. I open up the mailbox, and there's a nice check. I go deposit it, and I don't have to worry about anything, okay? But that, you know, is under kind of an absolute triple net, you know, sort of lease environment, whereas, you know, many properties fall a little bit further kind of over toward, you know, a gross lease or just a simple net lease where only a certain number of things are covered by the tenant, okay? All right, moving forward. So if we go through and we add these up, we end up with $325,000 as sort of our total operating expenses. Okay? Everybody good with that? All right? So now, your next line is the one that, once again, if you kind of go back to my simple model, is we're calculating net operating income. Well, in my simple model, what is it? Net operating income is effective gross income minus total operating expenses. Well, here, it's not that different. It's just that we are, in essence, taking total operating income, or EGI, and we are subtracting out total operating expenses, much the same as what we have called it, total operating expenses, and that is going to give us net operating income. So in this case, 1,275,000. Okay, does everybody follow that? So all that is, you can either refer to it as EGI minus total operating expenses, or, as they call it, total operating income minus total operating expenses. Okay, everybody good?
No, sorry, Professor. It's the 1,600,000 minus the 325, correct?
Yes. 1,600,000 minus 325,000. Okay. All right. Are we all good? Okay. Once again, I can write that out here if that is helpful. Okay. All right. Now, as we talked a little bit about last week, as it relates to sort of some of these items, they create yet another little category, capital and leasing costs. Okay, and under that, they have three items: tenant improvements, which we talked about last week; leasing commissions, which we also talked about last week; and a little bit of we talked about last week. I mean, at least we introduced you to the general idea of what capital expenditures are last week. But what we're going to be doing, excuse me, with each of these is we're going to be subtracting them from our net operating income in order to get this bottom line of what they refer to as unlevered cash flow. All right? So, yet again, to kind of try to keep things simple.
What would you call adjusted?
Oh, I'm sorry?
Would you call the adjusted anyway?
In essence, yeah. Okay? So, in this case, we'll say the tenant improvements I'm going to put down as $2 per square foot. Leasing commissions I'm going to put down as 50 cents per square foot. And capital expenditures I'm going to put down as $1 per square foot. Now, once again, I wouldn't say these are inherently reasonable numbers. I'm just sort of throwing some things out just to kind of work through the example. So in this case, this is going to be 100,000. This would be 25,000, and this would be 50,000. Okay, all of which will be subtracted out from your NOI, and then leave you with unlevered cash flow of $1,100,000. Okay? So just to make sure that once again, no one's falling off the bus here. That is 100,000 there. 25,000. Okay. So this unlevered cash flow, which really is going to be used for the most part to tell us, as the owner of the property, what is, after everything is said and done and we have literally collected all of our revenues and we have paid all of our outgoings, what are we left with? Okay?
Profit.
And in this case, we're left with this 1.1 million. All right? Now, the reason why we separate out these items that we're calling capital and leasing cost of the tenant improvements, leasing commissions, and CapEx is normally those are not going to be consistently recurring expenses, okay? So we tend to sort of isolate them, and we're sort of saying they're not really tied to the day-to-day sort of operations of the property, so therefore we're going to sort of separate those out. The operations of the property are all sort of captured here with our net operating income number, okay? Does that make sense?
Basically means that next year there will be $175,000 more in profit.
Yeah, and so like for example with these items that you may not be paying this next year. You may not be paying this next year. You may not be paying this next year. You know, those are sort of maybe one-time expenditures that should not really impact the operation of the property sort of moving forward. Does that make sense? Okay? All right, any questions from Zoom land? Are we all good?
Yeah, Dr. Forey, with respect to all of these expenses that we just went over, even with the leasing and commissioning costs and so forth, right now you're just using an arbitrary number.
Totally arbitrary. And the only reason I'm doing that is to try to keep the calculations simple and straightforward so that we don't get bogged down into, the complexity that we can get into if we start being much more precise, okay?
Okay, I understand. So in the real world, when we're out there and we acquire property, basically all these numbers are based upon actual invoices. We will have to make some assumptions up front, but eventually we'll have to adjust for actual.
Correct.
Okay.
Okay. And the thing about it is, there are all sorts of different services out there that collect every single year property level performance data. And like for example, you have the Institute of Real Estate Management, you have BOMA, the Building Owners and Managers Association, and a handful of others that every year they survey their membership, which are on-site property managers of properties all over the country, and it asks them to provide basically operating sort of percentages for the properties that they manage, so that in aggregate you can kind of sort of say, all right, in Miami, roughly for a retail facility that is X number of square feet in size, based upon this sort of survey data, here are the rough numbers percentage-wise for each of these individual sort of line items. And then you, as the owner of a similar sort of property, can then take and say, all right, yeah, I'm plus or minus, 5% or so on each of these sort of line items, except maybe on, I don't know, insurance. And maybe I'm paying 3 times as much on a percentage basis than everybody else that's being surveyed. So what should I do? I should probably take a close look at, why is my insurance cost so high? Relative to, in essence, my competitors, and see if, am I being overcharged? Am I getting coverage for something that maybe I don't need coverage for? Am I, do I have too low of basically a deductible on the property? So maybe I've got like a $1,000 deductible on the property, whereas all my competitors have a $10,000 deductible. Well, that dramatically impacts what your insurance costs are. Okay, does that make sense? And so my point being is being able to kind of use that to then hone in on, how can I make the property more efficient? How can I potentially enhance my revenue and hopefully diminish or decrease my expenses? Because like even on property taxes, as an example, you could have 2 literally identical properties across the street from each other in terms of shopping centers, office buildings, whatever it might be, and it just so happens that the one across the street does a better job of monitoring their property taxes, and as such, they get their property taxes reduced by, their valuation reduced by the local taxing authority, giving them, in one sense, a competitive advantage over you. Because if you're paying, $50,000 a year in property taxes, and they're paying $25,000 or $10,000 a year in property taxes, that's, if you can get yours lowered as well, that's like found money, But, part of the sort of, and once again, we're not a property management program. That's kind of what we do at the undergraduate level here. But, a good property manager is all about trying to minimize your expenses and maximize your revenue. I mean, it seems very obvious, but yet it's literally going through each of these sort of line items and sort of saying, how can we improve our, cash flow at the end of the day? Okay?
Property tax is going to be a little bit difficult to, if somebody pays 25,000, another person pays 50,000, it always relates to the purchasing price.
Not necessarily. Okay, it can relate to the person, but it has to be an arm's length transaction, in the meaning that it has to be a legitimate sale that took place, as opposed to, okay, my brother-in-law or my sister-in-law or my cousin or my uncle or something like that I sold something to, and the price I gave them was some ridiculous bargain basement price which has no reality whatsoever. Okay. But assuming it's an arm's length market transaction, then once again, if I, as the property owner with the higher property taxes, if I can then point to that sale and get the market data for that sale, then I can use that data to in essence say, my property is basically, worth the same as theirs. And that is a strong enough argument to be able to get my property taxes reduced.
Dr. Gordon?
Yep.
One last question. When we looked at the vacancy percentage that you used, that works really well on the larger properties, larger communities with 100 to 300 units or greater. But if, let's say we're a small time investor and we go out and buy a quad, and you have one of those units that's vacant for a period of time, it actually can be bigger than the percentage, like a 10% or.
Oh, sure it can. Yeah, I mean, if you have in a quadplex and you got one unit that's vacant year long, that's 75% occupancy, 25% vacancy. So yeah, There's no question about that. But, you know, you're always with residential properties, whether it's, you know, small scale residential or large scale residential, you know, normally you're going to obviously have a significant amount of turnover, you know, every single year of people moving in, people moving out, and then you're going to have, you know, the time in between that not only it takes for you to get it released, but also to get it make ready, you know, to transition from one tenant to another. If you're trying to do a good job as, let's say, a property manager, that, you know, you're not just one tenant moves out, they toss you the keys, and then literally another one comes in the door the same day and you give them the keys without ever really making sure the property has maybe, you know, been, I don't know, repainted or, you know, touched up and cleaned up in whatever way that it is completely usable, you know, at that moment. But, you know, even sometimes with the best sort of turnovers, you're still going to have, you know, some level of sort of natural friction that exists there of you know, almost never being able to achieve 100% occupancy, you know, in large properties. Now, having just said that, but then you also have the situation, and you bring up a good point, you know, what if you've got, you know, in our case, we just simply said we've got property A and property B. If those are each individual singular tenants, you know, if one of them moves out, that's a huge hit. And it could take us, you know, quite a while to potentially release it. You know, so the assumption that we made was just simply, yeah, we have a 10% vacancy, which, you know, is only going to equate to, like, you know, roughly, you know, maybe a little bit, around a month of lost income, you know, for whatever reason, that maybe it took a little while for somebody to move into the property and that sort of thing. But, no, your point's well taken, okay? All right, moving forward. All right. All right, so any other questions on this sort of cash flow statement? Okay. Not hearing anything, then we are moving forward. All right. Everyone's favorite topic of the semester, depreciation. Okay. So, one of the things that you have to do when we start talking about income tax, federal income tax, is that we have to start sort of talking about the tax world, okay? The tax world, and once again, if you see me doing the air quotes, there's a reason. The tax world is not the real world, okay? The tax world is something that is artificially constructed by our government. And that's not a political statement, it is a fact that simply what I mean by that is the rules and the regulations that apply to federal income tax on real estate is 100% dictated by law, okay? And sometimes laws, while they are intended to represent reality in some ways, do not represent reality, okay? And you're going to see what I mean as we get a little bit deeper into this. And this has, once again, this is totally non-political, totally apolitical. But every time Congress changes a law, like to deal with capital gains, to deal with depreciation, to deal with basically what is allowable or disallowable, you know, as basically a deduction, that changes everything, potentially. I mean, one of the most recent tax law changes, you know, a few years ago, a couple of years ago, one of the big changes dealt with property taxes. and specifically whether local property taxes on your personal residence would be deductible against basically your federal income tax. And what did they do? Anybody remember any of this? Well, prior to the change in the law, in essence, if you owned a home and you were getting, you know, potentially a tax benefit for that, maybe at the state level and at the federal level, you know, you were getting a nice little benefit. Well, then the laws have since changed, and a lot of the taxes that you're paying at the state level, if you have a state income tax, which we don't in Florida, but in many other states they do, then all of a sudden those taxes may be limited as to the deductibility from your federal income tax, meaning that if you continue to live in that particular state, it now is more expensive to live there than it was before, simply because of a change in tax law. Does that make sense? Okay. Now, as it relates to real estate, one of the things that they don't change very often, but they have changed every sometimes 20 or 30 years, are depreciation schedules and depreciation amounts and percentages, okay? Well, for real estate, thankfully, I think since like 1993, we've had roughly the same depreciation rates for real estate. And this is not for owner-occupied real estate, like residential, like your house. This is for real estate that you own as an investment. So, residential real estate, and in this context, when we're talking about residential real estate, once again, we are not talking about your owner-occupied house. We are talking about residential real estate that you own as an investment. So if you own a quadplex, or you own a duplex, or you own a single-family home that you rent out to someone, or you own a big apartment community, that is considered to be residential, okay? And in this case, in the tax world, that has a 27.5-year depreciation period. And yes, you're going to need to remember these. For commercial, non-residential, it is 39 years. Now, let's back the train up here for a second. Where did those two numbers come from? The 39 and the 27.5 years. From Congress, okay? Back once again, around 1993, whenever the last time they really messed around with this. And so, since then, we have been operating in an environment where the idea...
This is now federal or...
This is federal. The idea is that residential properties have a shorter lifespan than commercial properties. Why 27.5? Why 39? Because they thought that, you know, in their mind was somehow representative of reality. Okay, this is what I'm talking about when I'm talking about the tax world versus the real world.
That's what they compromised.
Okay?
Do you see that changing?
It potentially will, but at the moment, it's not. So, my point is, if you've got a residential property, for tax purposes, you get to take your depreciation deduction at a much faster, accelerated pace because it has a 27.5 depreciation period. In other words, it deteriorates or depreciates faster once every 27.5 years versus commercial once every 39 years. But now this is yet again, and we're going to get into this in much, much more detail. This is yet again where logic gets pretty much thrown out the window whenever it comes to tax law. Okay? Tax law is just a bunch of rules and regulations that, once again, people that live in that world, people that live in the tax world, that's the way, they have to understand those laws and rules and so forth. But yet, to many of us standing on the outside, we're saying, that doesn't make any sense to me, And this is a good example, and one that I'll give you. This depreciation term. It does not go with the property. It goes with the owner of the property. You're saying, what?
Yeah.
Okay. So I buy and or build a brand new apartment community. All right? And so, we're going to get into the calculations here in a minute, but what happens is, okay, I built that brand new apartment community. I start out my depreciation schedule, depreciating it year by year, starting with 27.5 years and reducing each year. So let's say that I own it for roughly 5 years, then you would say, okay, 5 years off of 27.5 would be that I've got roughly 22.5 years, or this property has roughly 22.5 years left of depreciation after having owned it for 5 years. Okay, that would be logical, yes? But in the tax world, if I sell that property to you after 5 years, the depreciation clock resets
Back to 27.
to back to 27.5. And the reason is because you're the new owner, and as such, you're taking on that property, even though it's 5 years old. We're going to try to make the assumption that during that 5 years, hopefully, I have maintained it to a standard equivalent to whenever I sell it. It's in essence, I rejuvenated it back to 27.5 years worth of life again. Does that make sense? Conceptually. Okay? Now, those of you out there in Zoom land, you're like, are you kidding me? Well, but the reality is, this is what I'm talking about. Tax world, different than the real world. And you cannot minimize that statement. And because it's one of the fundamental truths of people, in essence, either being able to take advantage of those rules and regulations and work them to their advantage, or be taken advantage of by not knowing and not understanding those rules and regulations. Because think of it like this. Let's assume that I keep abreast of all of these tax law implications on real estate ownership. But you don't, okay? And we both own similar properties. So what can happen is, because I know what I'm doing and potentially you don't because of not understanding all those tax law implications, at the end of the day, I'm walking away with more income, more revenue, potentially to be able to put in my back pocket than you are, okay? Because you weren't aware of certain things that you can and can't do that would benefit you, okay? Now, sometimes it can also work blissful ignorance, in the sense that by not knowing about something, you just happen to get away with it. But if you were to be audited, then the wrath of the IRS comes down on you, And ultimately, then you potentially have to pay back what maybe you didn't potentially either declare or expense properly or whatever it might be. Does that make sense? Okay? Question? No?
I do have a question, because when you say it resets at 27.5, what happens is when you sell it after the 5 years, and you took those depreciation over the 5 years, when you sell it, you again have to take that gain that you made in those 5 years.
You get what's called recaptured appreciation.
So you lose that advantage.
Yep, and we're going to talk about that as well.
depreciation. So, and that's why it resets to
We're not there
27
yet, but we're going to talk about it. Okay? We're definitely going to talk about it. Okay. Now, the caveat to all of this is only the improvements are depreciable.
Can I ask a really quick question? I'm sorry. If, say like, your parents or somebody owns a property, and then they die, and then they leave it to you, and then it gets transferred into your name or transferred in some form of, like, whatever, it could be trust account or whatever. Does that restart again?
You gave two different possibilities. If it transfers to you, like their name
To my name.
to your name exclusively, then that is going to be a transfer. You are going to be the new owner. You can reset the clock.
Okay.
If it's through a trust, and it's like a family trust,
Yeah, or something, yeah.
no, but that's different.
Okay.
Because the ownership doesn't transfer. You are not the owner of the property.
They're
The-
still technically the owner.
No, they are not.
Trust.
The trust is the owner of the property. Because a trust is set up for the benefit of people. And currently, let's say, the trust is set up for their benefit. Whenever they die, then that benefit of the trust transfers to you, but you're not the owner of the trust. Let's put things in perspective. You are not the owner of the trust. You are a beneficiary of the trust. And this is where, once again, the legalities make all the difference in the world, because there's no transfer occurring in terms of ownership transfer. All that's happening is we've got a new payer, or a new beneficiary. For example, same sort of thing would be true, because a trust, to a certain extent, is a lot like a company, or a lot like, you know, it's an artificial entity set up to do business. You know, this whole thing of, are corporations people? Well, in one sense, they have an identity. They do have their own sort of responsibilities and obligations. So for example, let's say that I start a company and I buy a bunch of real estate in that company. And then over time, I sell you shares of ownership in that company, all right? Is that a transfer of ownership? No. I mean, because you are, the corporate entity is the owner, okay? You are buying shares. Now, even if I gave you all of my shares, that still does not constitute a transfer of ownership, because the corporation is the one that owns the property, and you are not the corporation. You are simply a shareholder of the corporation. Does that make sense? And most of you, if you haven't already, are going to be taking a real estate law course coming up in the winter. Those are specifically the kinds of little nuanced questions that you can kind of get into with David Weissman, who is absolutely incredible.
I'm just seeing what the working around that kind of is.
There's usually some sort of way of trying to minimize your tax liability while being legal in doing so. There is a very different, very distinctive thing of trying to minimize tax liability as opposed to in some way commit fraud or,
Evasion.
you know, do something illegal that where you are avoiding, let's say, tax liability in a non-legal way, okay? And so this is where, in the tax world, you know, it's a very interesting world because people will try all sorts of things to minimize their tax liability, some of which are legal, some of which are not. And one of the things that you have to sort of be aware of is that just because you have, quote unquote, gotten away with it, you know, something legal, doesn't mean that, you know, it is legal. It doesn't mean that you won't potentially have to, at some point, be held accountable for it, okay? And here's kind of what I sort of mean is that there are a lot of people that, from a tax perspective, will try to roll a lot of personal expenses into their business, okay? So for example, let's say that you own real estate and you have a property management business that you run that manages your real estate. What, you know, I have seen a lot of people do is they will try to do everything imaginable to put personal expenses, everyday living expenses, into that property management firm, you know, whether it's their vehicle expenses that maybe they're not just using for business, but they're using it for everything else, food expenses, entertainment expenses, you know, trips to exotic locations, you know, expenses, you know, all of those things, if done properly, may be able to legitimately be able to be used as deductible expenses, but in many excuse me, in many cases, some people take this to the extreme, and in essence, they're breaking the law, and they may not, even in some cases, even realize it, but yet what can happen is a few years down the road, all of a sudden the IRS says, hey, we're going to audit your tax returns for the past, you know, 5 years, and as a result of doing so, they uncover all of this sort of stuff, and the next thing you know, you owe a heck of a lot more, plus penalties, simply because you didn't do the right thing to begin with. Does that make sense? Okay? But, having just said that, there are also some relatively obscure pieces of the Internal Revenue Code that may or may not allow you to be able to do something like take a certain deduction that you didn't think that you could, you know, be able to take, that could give you a big benefit, and the IRS may come along and may say, you can't do that, but yet you may have an accountant that says, oh yes we can, and they know with specificity, you know, by virtue of the detail within the Internal Revenue Code, yeah, we can do that, and then you're off the hook. But that doesn't happen very often. Well, it happens a fair amount, but the point being is that sort of thing, you know, is just another aspect of this. I mean, that is an actual real story from probably 30 years ago. One of my professors at Texas Tech University, he was a real estate professor, and one of the accounting professors was his CPA. And he was trying to take, or his CPA, the accounting professor, was encouraging my professor, the real estate professor, to take certain liberties with respect to certain deductions and so forth, so on. Anyway, and so they submitted the tax returns. And then next thing you know, here comes the IRS doing an audit and saying, you know, so the IRS agent basically came in, does the audit, and specifically on this particular point was like, you can't do that. And this is one of those pure moments of redemption, whatever you want to call it, that is just, it has stuck with me for 30 years. The tax professor, who once again was serving as the CPA, said to the IRS agent, oh yeah, we can do that. We can absolutely do that. I know we can do that. And the reason I know that we can do that is I wrote that section of the tax code.
Oh my God.
And, and so it was just kind of like that, woo, because obviously somebody has to write the tax code. Well, who else than in some cases professors? So kind of an interesting thing. Okay, moving on. So the thing about depreciation is, and the caveat that I was trying to get through, is only the improvements to a property are depreciable. Land is not depreciable, at least from the perspective of the IRS, okay? We could probably sit here and make up arguments as to how land might be depreciable, but the general idea is, okay, you build something on top of the land, those are considered to be improvements, okay? And over time you use those improvements, and after they become useless as improvements, you can do what? You can get out there, and obviously our business is all about it, you bulldoze it, you end up with sort of fresh, freshly scraped land, ready to rebuild something on top of it. Has the land been diminished in value as a result of doing that? No. In some cases, probably been enhanced in value, because maybe you went from having a situation of where you got a single family house on maybe an acre of land in a prime location to scraping that house off the land and, assuming the zoning would allow for it, being able to build a substantial project on that property. So the land is not depreciated. In some cases, it has been enhanced in value dramatically as a result of that. But, as I said, there are always people who try to come up with quirky things to sort of throw off this whole thing about land not being depreciable. Like, for example, cemeteries would be a good example. Once you fill up the cemetery, it's full, okay? So you probably can't put any more bodies in the cemetery, all right? And, unless you take out the existing ones and,
It's really creepy. Actually.
burn and dispose of them and put new ones in, or, whatever. But, for the most part, once you use it, it's done. Or you maybe have a radioactive, contaminated site or something like that. Yeah, you can make the argument that has been depreciated, okay? But normal circumstances, land is not depreciable. Okay, so what does that actually mean? All right, so here's where we begin with some of the little problems. So let's say that we acquire this property for $100 million. Okay? And for this property, we have sort of said, let's say 20% of that is the land value. So what that leaves is $80,000 in improvements. Okay, does that make sense, everybody? Yes or no? Okay. So, what dollar amount is depreciable? 80 million. Okay. Not the overall 100 million, because that contains the land, okay? So, the 80 million is the depreciable amount, okay?
Commercial or residential?
That's what we're about to talk about. All right, so let's assume that it's residential versus commercial. All right, and we know that residential, 27.5 years depreciation versus 39 years for commercial. So what we're going to do is we're going to take that 80 million, divide it by 27.5, and over here we're going to take that same 80 million, divide it by 39, and we're going to find out the annual depreciation amount for the property, depending on whether it is classified as residential versus commercial. Okay. So in this case, our annual depreciation would be 29,090.91 over here. $2,051,282.05. Okay? Everybody get that?
Mm-hmm.
All right. So, for the purposes of income tax, which property, and once again, I haven't gone into the detail on this, and so this is only you kind of having to try to infer from what we've been talking about. If you had the choice and all other things were equal, which would you prefer to own, the residential or the commercial, for tax purposes only?
Residential.
Commercial. Residential.
Residential.
Okay, how many of you say residential? Zoom people, put your hand in the air. How many say residential? Okay, how many say commercial? Okay, commercial people are wrong. Residential people are correct. The reason is you are getting a higher deduction for the residential. You're getting like $900,000 a year of additional deductibility for tax purposes off of a residential property than you are off of the commercial. So if you had to choose between one or the other, you would choose residential. Now, what if you have a mixed use property?
Oh my God.
Wait, so is this how much you're paying? Or how much?
No, we're getting to that. Right now,
That's
this
why
is,
I'm just like, what?
right now we're just talking about the depreciation
Value.
dollar amount. Okay. Now, what if you have a mixed use property?
Is that a different number?
How does that get treated? Like, for example, let's say that you go and you build kind of one of these, you know, kind of urban sort of apartment communities where you've got retail and office on the first floor, and then maybe 4 or 5 floors above that that are purely residential. How does that building get classified?
It's commercial.
Okay, anybody else?
I would guess that the whole thing is commercial, or maybe pro rata share of like the amount of square footage you use as residential versus your commercial element.
Okay, anybody else?
Mixed use office, retail, and
Once again, the first, let's just say that we're talking about, I'm gonna make it, first floor is residential, and then the top 4 floors, so we basically got 20% commercial, 80% residential. How would you think that would be classified?
Residential.
No, okay, somebody, Hannah, are you out there? You just wrote a comment. I understand what you wrote, but what you're writing about is not the same thing, okay?
That's cool.
You're saying over 4 residential units is considered to be commercial. That is in the context of more of dealing with how you are able or not able, or a lot of the sort of housing laws that you maybe have to adhere to as a property owner in terms of restrictions on who you can rent to, who you can not rent to, those sorts of things, dealing with sort of this residential, sort of number of residential units. In the context of what we're talking about, residential can be hundreds of units, okay? Because this is about tax law, okay? We're not dealing with the context of what, because here's, okay, a lot of people, we have all these weird little ways we refer to things, and people tend to think, okay, if I invest in a little apartment community, that's considered to be commercial real estate. No, it sort of kind of is, but it's not. It's a residential property, but yet it is for commercial investment purposes. That is not to say it is a commercial property, okay? And there are some weird little distinctions there. Trust me, dealing with this for over 30 years, I'm telling you, it's a weird little sort of distinction. But what we're talking about is what happens if I've got this massive apartment community, and the first floor of that apartment community is office and retail space, and then the upper 4 floors are residential. And how is it going to be classified for tax purposes? And the reason why this matters, you would think, first of all, if it has single ownership, it's one owner, it's not condominiumized, one owner for the property, you get to claim the entire property as residential. If it's 80% or more residential by square footage. So my point with that is that gives the owner of that property a distinct tax advantage because they get to claim more depreciation off of the property than they would if it was commercial.
So is this 80-20, that's the law?
Right.
So if it's 80%
Or more.
or more, it's considered residential. If it's 79% or below, it's commercial.
In essence, yeah. Okay?
If it's less than 80%, does the whole thing get classified as
Yes.
commercial?
Yeah.
Okay.
No. Residential.
No.
In other words, okay.
But if I see what you're saying, if the residential units are less than 80%, does the whole thing, if the whole thing gets classified then as commercial?
Yeah.
Right?
Then, my understanding is then it gets proportionalized.
Okay.
So it's kind of one of these things that it's sort of like the IRS or the tax law is favorable to you having this little bit of commercial in there, but if you've in essence got more than that, then they kind of sort of say, okay, now you've got to itemize in the sense of separate it out.
And hotels with retail are obviously all commercial.
Correct.
Even if they don't have retail, it's just a hotel.
Yeah, but see, hotels are not considered to be residential.
Exactly.
Hotels are considered to be commercial. Now, this is where, once again, it can also be very tricky.
Because they can have them as residences.
Yes, they can.
Like here.
Now, for several years, as I think I mentioned, previously, I taught in New Zealand for a handful of years, I don't know, probably 15 years ago. And while I lived there, I actually lived in a place that was, in essence, like a condo. All the units were individually owned by, let's just say you got 100 units in the tower. They're individually owned by individual owners, but the mix is totally dependent on whether the owner wants to place their unit into the hotel pool versus being their personal residence versus being a unit available for rent. They have that flexibility. So you really, as the owner, could have your property set up at least 3 different ways. So you could say, I'm going to live in my unit, this is my personal residence, I'm staying there, and that's how it's going to be all year long. You, on the other hand, are saying, I don't want to live there, I bought this as an investment, so I'm going to lease it out to a single tenant like myself. I'm going to live there, you know, for however long, have, you know, a year lease, whatever it might be. And then you may say, oh, I don't want to mess with any of that. I want to put it in the hotel pool. And in essence, the hotel will fill up my unit, you know, as the demand is there to fill it up.
Right.
But in addition to that, they also had flexibility of you're the one saying, hey, I want to live there all year, but they had, you know, had a lot of people that would live there for half a year, and then they would take all of their personal effects and put them into, in essence, like a locker for the next 6 months, and then during that next 6 months, it would either be leased out in the hotel pool or potentially go to a short-term occupant, okay? Does that make sense? Mm-hmm. To me, it was kind of the best of all worlds, you know, and you didn't know, you know, as a resident of the building, who was what, unless you actually started asking questions. But it was just kind of an interesting, you know, dynamic of being able to kind of have that freedom of doing anything you wanted to.
And
now in
that's when it's
Florida,
like a residential tax.
I'm sorry?
So when it's like separated like that, where you can own in a hotel, then it's considered residential, that's the only time?
That's what I'm saying. That's where it gets really complicated. Then it's going to be probably dictated by the percentage of the number of nights of the year that are in one versus another, and it's going to get much more messy for tax purposes. But my point is, well, actually, the point on this, like in Florida, you probably would never be able to get away with that because of homeowners associations being crazy about wanting to know every little detail about someone before they move into a community. So
yeah, the Atlantic on the beach is like that though. That hotel on the beach in Fort Lauderdale, you can own them. So like when you go in, there's like a closet and
Yep.
it's like completely locked, and like you know that there's like people's stuff.
good to know.
But everything is exactly as like a hotel. It looks like a hotel.
Yeah. Okay. Cool. Okay. Moving on. All right. So this is our annual depreciation amount for the property, depending on which way we tend to kind of go with it. Now, how does this really impact anything? All right. Well, first of all, get back, and you hear me saying this a lot, and I'm doing this on purpose. This is about the tax world, and this is about this number impacting your tax liability, okay? So this number, no one is writing a check or receiving income based on this number, okay? So in other words, whenever you hear about depreciation expense, it really isn't an expense in the proper sense of the word. Is you're not writing a check for depreciation. It is simply what you are saying is that for tax purposes, this property or the improvements of it have diminished by that dollar amount each year. So what you're sort of saying, and I'm about to contradict myself on purpose, this is where it gets kind of weird and nasty. So, in other words, you buy the property at the beginning of year one, this is its value, 80 million.
That's a value.
Yeah, of the improvements, the depreciable value. Okay, at the time of purchase, the depreciable value is 80 million. Okay, after 1 year, spell. Try that again. After 1 year of depreciation, the value at year end of first year or beginning of second year, this is the new depreciable value. Does that make sense? And so every year thereafter, you're basically lopping off $2.9 million of the value of the property for tax purposes. So that in essence, for the perspective of the IRS, the value now of your property is going to be, after 1 year, the $77,090 plus the $20 million in land, or basically $97 million. Does that make sense?
But wouldn't you want it to be valued at low?
What, I'm sorry?
No, can you repeat that?
Not for the taxes.
Okay, okay, one more, okay, let me get yours, and then I'm gonna get, is it Annalise? Is that correct?
Yes.
Okay, let me get yours in a second, Annalise. Juliet?
This might be a dumb question, but like, wouldn't you want it to be valued at lower?
Okay.
I'm just like.
No. Okay, the question from Juliet was, wouldn't you want it to be valued more? This number
It's for just tax.
is for taxes, that's what I'm saying.
No.
Tax world, not real world, tax world,
I don't
okay?
like tax realm.
All right, Annalise,
I like real world.
question.
Yeah, you mentioned something about 90 million right after you were
Okay.
talking about this.
In other words, this is the depreciable value of the property. The 77 million is the depreciable value, but the total value for income tax purposes, you'd have to add back in the land of 20 million, so it would be, the total value would be 97 million.
God.
Okay, does that make sense?
Because you're adding the 20 million from where? Oh, from the top, I got it.
From the land.
Got it.
Okay, now, so in essence, okay, question.
So that 2.9 million, that's consistent throughout the entire lifespan. It's not like, you know, the next year you need to take that 77 mil and divide it by 30.
Well,
33.
not quite.
26.5.
Here's what's going to happen, is that for every year, really after the first year, it is going to be a consistent amount. But in the first year, it's going to be probably less than that amount because of the month in which it was acquired. So if you acquire the property 6 months into the year, you in essence are getting roughly half of that in depreciation. If you acquire it at the end of the year, you're only getting, roughly, a half a year, or I'm sorry, half a month or something of depreciation. If you acquire it at the beginning of the year, you actually get 11 and a half months of depreciation. And that is something that you actually prepared for the next topic on this, which is something called the mid-month convention. Okay?
I don't like that. I'm just.
So let me just say that your heads will explode pretty much, if you've been watching that Amazon show called The Boys. Anybody been watching that show at all? No? Okay. Well, anyway, they have apparently a character in this show that can make people's heads explode. And that's sort of how I kind of feel whenever we go through this, because it's probably going to make you do that.
This quiz is going to be real fun.
Hey, sir, real quick.
Yep.
Would the second year's depreciation be off of, I just want to clarify this, be off of the new 77 million now?
Yep.
So,
Yep. Let me go through this next piece, and it will all become self-evident. Okay? Okay. All right. As I said, we're gonna put all this in context here in a moment, and it will become that much clearer. But one of the weird little caveats of the law, okay? You're beginning to see why I started out the lecture with tax world versus real world, okay? One of the caveats of the law is you have something called a mid-month convention. And what that means is depending on when you purchase a property and you place it into service, place it into service is the key operative word here. And what that means is it's available for rent, it's being rented out, or it's being occupied. That is when the depreciation clock starts, okay? But in their infinite wisdom to basically construct this process, instead of having you just simply prorate it based upon the day of the year that you acquired it, like, in other words, we pretty much have 365 days a year with the exception of leap year, you know, that sort of thing, okay? Where it's 366, okay, every 4 years. So you could just say, all right, well, depending on when it's placed into service, we just simply take how far into the year we are, and then divide that into 365, and, you know, that's the percentage of the year that we get. No, they did not do that. What they instead said was, that was too much work. So instead, they came up with this situation of where, depending on when you place it into service, what month you place it into service, we're going to make the assumption for tax purposes that it was placed into service in the middle of the month, or in essence the 15th of the month. Regardless of whether it was placed into service on the 15th or not, that's the assumption that it was placed into service at the middle of the month. Now, you're saying, well, wait a second. So what you're saying is, if I bought it in January, and I placed it into service on January the 1st, you're saying that I am, for tax purposes, going to make the assumption it was placed into service January 15th. Yes, you are, okay? Because that's what the law basically says you have to do, all right? By virtue of the mid-month convention. So for example, in January, regardless of when you place it into service, the assumption is made that it's placed into service the middle of the month. Or, what that means is you don't get 12 months worth of depreciation, you are going to get 11 and a half months. Does that make sense? So for example, I can buy property, place it into service on January the 1st. I get 11 and a half months of depreciation. I can buy it, place it into service January the 10th. It's assumed January, it's basically assumed still 11 and a half months. I could buy it, place it into service January 31st. I still get 11 and a half months of depreciation. So there, bonus, I get half a month worth of depreciation that I didn't really earn because I placed it into service after the 15th of the month. Does that make sense? Now, so every subsequent month, and I'm doing this because you're going to need to know this. Oops. Hopefully I don't forget a month. All right, so we just got to go down the list. 10 and a half, 9 and a half, 8 and a half, I'll kind of draw a line just so we, 7 and a half, 6 and a half, 5 and a half, 4 and a half, 3 and a half, 2 and a half, 1 and a half, and half. So, let me just see if you're paying attention. So let's say I bought a property and placed it into service today. Today is what? October the 24th. Okay? So, how much depreciation do I get?
2.5 months.
2.5 months. Because it falls in the month of October. Doesn't matter what day of October it is, it falls in the month of October.
It's before or after the 15th?
Correct.
Any day in October.
You get 2.5 months worth of depreciation. So, for our example, if we go back up here, we have the 29, 09, 090, 91. Basically, take that number, divide it by 12, and you get 242,424.24 per month of depreciation. Okay, does that make sense? Okay, so tell me, we're placed into service today, October 24th, what is the total dollar amount that I get depreciation for this year? See if you can figure it out. It's not that complicated. You're going to multiply two numbers together.
606,060.
So if it's placed into service October 24th, then we're going to be using 2.5 months. So all we're going to be doing is taking the 242, 424, 24 multiplied by 2.5 months.
3606.
So 600, 6,000, 060, 61 rounded would be the depreciation for year one.
It's 60. Okay.
Well, I rounded. It's 606. You're just rounding off to 2 decimal places?
Yeah, but it's 600,000.
Well, it's probably because you rounded something else. Okay. All right. So I'm not going to take off for a penny.
No, it's okay.
Okay. All right. So this dollar amount, the 606,060.61, that is the amount of depreciation that we will be able to take this year off of our income taxes. Does that make sense? Now, getting to the point that, where'd he go? Oh, there you are, Kip. All right, the point that Kip had earlier. So, now, what is going to be the case is, for the purposes of constructing our income statement, year one depreciation is going to be 606,060.61, and then year two is going to be the 2909, whatever it was, 090 point whatever, 91, and that amount is going to stay constant through, in this case, was this residential or commercial? This one was, yeah, this one was residential. So basically, through year 27 and a half, we're going to have the 2909 each year of depreciation. And then the very last half a year will sort of make up the difference. But we are not going to have to worry about that. That is almost immaterial because we're never going to probably own the property that long. But in the first year and the second year and then most of the subsequent years, it's going to be simply that 2909, okay, for years 2 forward. Does that make sense, Kip? All right. We've gotten through the easy stuff. Okay. So, that gets us through mid-year or mid-month convention. Okay, so for those of you trying to keep score, we are in essence on, we just finished up question 6. All right? Now we've got question 7, 8, 9, 10 to go.
But that's a question by itself.
Of course it is. Yes. Okay. Now, next topic, and we're going to be integrating all of this here in a minute, but right now we've got another issue. Amortization of points. Okay? Or loan points, just to be precise. All right.
What's question
Can we
6?
go to the...
Huh? What?
Can we
Where's
make
the
a break?
question? What do you mean questions?
That's from the
For the quiz.
Oh, in the quiz.
Can we make a break?
Okay. So, the next item is amortization of loan points. Those of you that took the real estate finance class, you know what loan points are. Those of you that have not taken the real estate finance class, you probably have no idea what loan points are, and that's okay, because I can explain that pretty easily. Whenever you get a loan on an investment property, whether it's residential or commercial, one of the things that you have to typically do are to pay upfront points or upfront money to a lender to basically compensate them for making you the loan. Now, in the back of your mind, wait a second, what are you talking about? Am I not paying them an interest rate, for the loan? Yeah, you are. But in addition to that, in most instances, you also pay what are called loan points, meaning there are additional funds that you pay for the privilege of getting that loan. So, like, for example, you go to get a loan for $80 million, kind of following through this example. We're going to put in 20% equity. So we're going to put in the land value of this previous deal that we just dealt with, $20 million. The remaining 80% is going to be debt, or money we're going to borrow. All right? So that $80 million loan, we're going to probably, we're going to have to pay some sort of an interest rate, like, whatever, 5% interest rate on the loan, and we're going to have a monthly payment associated with that, and so forth, so on. Okay, we're not concerned with that right now. What we're concerned with is we're going to probably have to pay some sort of upfront charge to the lender for the privilege of them making us the loan. In other words, think about it, whenever you go in to get a loan, what does the lender have to do? They have to process all sorts of things. They have to underwrite the property. They have to eventually get an appraisal on the property. They have to go through, a whole sort of evaluation of the property's potential, okay? And in order to be able to do that, it costs them money, all right? So instead of just simply rolling that into the interest rate, they charge it to you in the form of some sort of a fixed fee or charge, usually as a percentage of the loan amount. So let's just say that they charge you 1%, okay, of the loan in fees or loan points. So basically, you're paying $800,000 in loan points to the lender for the privilege of being able to get that loan.
That should be in that business.
Does that make sense? Okay, now, for the purposes of our taxes, the IRS says, that's wonderful that you went and you got that loan. It's wonderful that you had to pay these points up front to get the loan, and you went out of pocket for that $800,000 up front. But the IRS says those points are really compensating the lender. Even though you're giving them the money up front, it's compensating them over the life of the loan. Okay? And so what they force you to do, once again, this is tax world, not real world. Okay? James, your phone is kind of backing up on you. Okay, so this is tax world, not real world. So what that means is if we have a 15-year loan or mortgage, then what we have to do is we have to take that $800,000 divided by 15 years, and that means for income tax purposes, we are allowed to write off $53,000 of that each and every year for the next 15 years. Okay? Even though we pay for it up front for the purpose of income taxes, the benefit that we derive from the deductibility of it, we have to amortize it over the life of the loan. Does that make sense?
That means if you pay it back early, you cannot deduct.
No, if you pay it back early, then we're going to get into that later. Let's not get into that right this minute. Because we have a whole thing, recaptured appreciation, and obviously we've got to deal with points and a handful of other things. So don't get into that right this second. Okay. Okay, so for the purpose of, so this would be, once again, the annual amortization of the points, of the loan points. Okay? Any questions? Okay? That was question number 7. Okay? Next is going to be before tax levered cash flow. Okay? All right, so we've got these 3 topics left. At this point, we're going to take a 5-minute break. Okay? So it's officially 10 o'clock. So around 10:05, we're going to get started or restarted.
So far, there's a lot less calculated and finance, but that'll be coming later, though, like next class maybe.
Well, yeah, right now it's just adding, subtracting, multiplying, and dividing. So.
Oh, okay. So even though it's amort, we're not actually doing the whole input amort.
No, because we're not dealing right now. Right this minute, we're not dealing with time value money.
Okay.
Excuse me, Professor.
Yep.
I have 2 questions. First, you were saying you're going by a certain number of questions that were question number 7. I'm sorry, what are you referring to? Is it
On the quiz. Question number 7 on the quiz.
the quiz number 1 that we did?
No, quiz number 2 that is due on Tuesday night, or Monday night.
Oh, okay. So these are examples that we're gonna have to do in the quiz?
Correct.
Oh, okay. My other question is, for quiz number 1, if I wanted to go over some of the questions with you, when can we do that?
Well, what I'm actually going to be doing is probably sometime this next week we'll be posting the solutions.
Yeah, no, you, for quiz number 1, you already posted the solutions.
No, I didn't.
And, yeah.
No, I didn't. No.
Oh, that's right. You only put the answers.
Yep. So that's why I post the solutions. That way you can go back and see what you did or did not do.
Yeah, and some of them I just like rounded wrong. I mean, but I did it correctly and I got the answer. It's just that I rounded wrong.
Well, and I adjusted. If somebody had a rounding error, I gave them credit.
Oh, okay. Thank you. This is my first real estate class, so I'm a little trying to catch up with them.
I do have a question regarding those pairings that you're doing, that it was mentioned that was going to be done with students and people in the...
We're actually, it's on my agenda of things to talk about today.
Wow.
Because now that grades are in for the first half of the term, then we can do the mentor matching.
First half of the term?
First 8 weeks. What we typically do is we don't do the mentor matches until a person has successfully completed the first 8 weeks of the program to ensure that they're going to pass. Because it doesn't make sense to pair somebody with a mentor if they don't pass. So if they're able to pass the GIS course and they're able to pass the
If, like, for instance, like I went I disenrolled, or however you call it, I dropped the class of the GIS, so I'm doing 3 classes instead of 5 classes now. So then there's no pairing, or how does that work?
We'll talk about that and how that works.
So we meet with the mentors whenever we want. We just
Yeah, and that's we're definitely going to talk about it. Just as soon as I get through these next 3 or 4 things, then we will spend some time talking about it.
I got a question on the midterm for this class. Is it the same way as the finance where you take the highest grade, or is it, or do you not? If you to get lower, let's say you get lower, do you take that grade on the midterm?
Whatever it says in the syllabus, and I think it's the highest of the 2. Okay, we're still missing one person here. All right, the Zoom people are still out there somewhere.
Why are so many people not in class today?
That is an excellent question, Max, and I don't have an answer.
I mean, okay, sure, it's great weather after rain, but really?
Well, my perspective is relatively simple. You know, people show up, they don't. Ultimately, they watch the video, they don't. Ultimately, they're going to take the quiz, and chances are, if they don't watch the video or don't attend class, they're not going to pass the quiz.
He's so cute. He's like really, really, really like if I'm on the screen, like FaceTime or
All right.
whatever, he like comes into the screen because he just wants to do it. This is him yesterday.
Almost there for this.
I'm like, my baby.
Okay. Now, so in this particular case, what we are going to be looking for is called just simply before tax levered cash flow. Sometimes I just tend to abbreviate it and call it before tax cash flow. So if you kind of go back once again to, in essence, my little simplified kind of income statement. We have the potential gross income, subtracting out vacancy and collection losses, and adding in other income. Oops. Getting effective gross income, subtracting out total operating expenses that gave us NOI. And that's kind of where we had stopped. But then, the next step is typically to subtract out your annual debt service, or in other words, your loan payments. And then that usually gives us our before-tax cash flow, okay? Now, in this case, so let's just say that we've got a property that, and what we're going to do for the purposes of the cash flow is, let's go up, let's see if this is usable or not. All right. If I want to sort of stick with kind of the example that we had used at the beginning, where we had the unlevered cash flow of 1.1 million. So let's kind of use that as an example here. So unlevered cash flow of 1,100,000. Okay, and then from that, let's say that we have loan points and in this case, let's just say they are going to be $53,333.33 if we use kind of the ones from the previous example we just finished up. And then also, we have our interest payment from our loan, which we haven't really talked about, we haven't really gotten into. But let's just say, I'm just going to pull a number out of thin air on that one, just because I'm wanting to work through an example of 300,000. Okay, so we subtract out basically.
It's yearly.
Yeah, in this case, it is. What would be then our before tax levered cash flow? Okay.
I do so well in class, and then I take the quiz, and I'm like, what?
Okay, so we've got the before tax levered cash flow of $746,666.67. Now, this term levered, that just simply means there's a loan involved. Okay, it means we're using financial leverage or we're borrowing money. So that's where that term levered comes from. If we weren't borrowing money and it was an all-cash deal, then it wouldn't matter, okay? Because it would be just unlevered, okay? Okay, so that gets us through basically question A. So we've got two more topics.
Where'd you get the interest payment?
That one I just made up, out of thin air.
So you would just give us that?
Yep.
Usually, okay.
That was question 8, what?
In essence, yes.
In essence.
Okay, so now to calculate our taxable income, we need the following variables. Net operating income, annual depreciation, our interest payment, and our amortization of loan points. Okay? So what we're going to be doing is basically taking NOI minus annual depreciation minus interest payment minus amortization of points, and that is going to give us taxable income. Okay? So, to the extent that we can use some of these previous numbers, because these were sort of two different examples and kind of interspersing with each other, that's why it's a little bit wonky on that sense. But we can go ahead, I'm going to go ahead and try to use as much as I can. So let's say we've got $300,000 as our interest payment. We said that our amortization of loan points was 53, 33, 33. Our annual depreciation for the first year is $606,000. $606.
06061.
06061.
Okay, but it's important that we take that first year first.
61.
Like this is
So
the-
all of those, yeah, are going to be subtracted. And I don't really know that I've got a good usable NOI on this. No, I don't, because that number's way too small. So I'm just going to make up an NOI number here, let's say of $10 million. All right, and we subtract out these.
But it will be said that this has to be the first year.
Right. So 10 million minus 606, 061.61 minus 53, 33, 33. So 9,040,605.06. Okay, now that gets us through question 9, but let's explain this. Okay, we're almost done. All right, so assume that we've got a property and it's generating $10 million a year of NOI, and then during the first year we have annual depreciation, let's say of the $606,000, then we have the interest payment of the $300,000, and we have this amortization of loan points. All of that is simply used to come up with what our taxable income is. This is not our real income in the sense of the money we're putting in our back pocket. This is a series of calculations to come up with what is the number that our tax payment is going to be based on. Does that make sense conceptually? Okay? So, just for fun, we look at, let's say this is year 1. Year 2, I'm doing this on purpose, year 2, that depreciation number is what? Wasn't it what, 2909, 091 or something like that?
It was 2909 090.91.
Thank you. Okay, so in the second year, obviously that depreciation number jumps up significantly because now we get the full year worth of depreciation. Our interest payment, assuming that it's an interest-only loan, let's say stays the same. And then our amortization of points is also going to stay the same. So in the second year, because of that increased depreciation, okay, I want you to take a look at those two numbers.
Such a big difference.
Okay, but see what the difference is. All attributed to the extra amount that we're getting to depreciate in that second year. Now, you could also make the point that probably our first year NOI wouldn't be that large either because the property really wasn't placed into service until the end of the year. So, that point is also well taken, but assuming, for whatever reason that we've still got a lot of NOI in that first year, but the point is, all I'm really trying to get into your head is that during the second year, because of that depreciation, that's lowering substantially our taxable income, which is, once again, what our income tax is going to be based off of. Does that make sense? Just conceptually, yes or no? Mm-hmm. Okay. Yes. Now, this gets us to question 10, or the last topic.
Dr. Forey,
yep.
Before you move forward, in our finance class, you mentioned about the tax credits. Is that the line item where the tax credit will come into play on the taxable income?
Yes.
Okay.
But we're not there yet. Okay?
So that would be for year 2 and all the other years, it would be the same, right?
Theoretically, assuming that everything stays constant. Yeah. Okay. Okay, after-tax cash flow. So here, what we're going to be doing is we're going to be taking that before-tax levered cash flow. I don't like calling it that, but that's what they call it. Levered cash flow. All right? And we're going to be taking a look at our taxable income. And we're going to be taking a look at our marginal tax rate. Okay, which we're going to explain. So let's just start with the pieces we know. And then this is ultimately, we're going to get to our after-tax cash flow. All right, so our before-tax levered cash flow, if we kind of go back up here, was $746,666. God, I can't really use these numbers. Okay, I'm going to on the quiz. I give you fresh new numbers, so that's what I'm going to do here because otherwise, I'm mixing and matching some things that aren't going to make any sense for us to do. Okay, so let's just assume that I give you a before-tax levered cash flow of $1 million. And I give you, well, actually, we can do $10 million, that's fine. We can do $10 million of levered cash flow, but that was, NOI, that's not the same. I don't want to mix and match these anymore because this is going to be confusing. All right, I'm making it $1 million. Our taxable income is, let's say, $600,000. All right, and then, so at this point, what we have to do is, if we've got our before-tax levered cash flow, and we've got our taxable income, the taxable income is the one that we are going to apply our tax rate. And in this case, let's say that our tax rate is 28%. And once again, that is a number that is simply given to you, and it is a real number. 28% is a fairly reasonable standard number to use for this. So 168,000, okay, is going to be your tax payable. All right? So what you're going to do is you're basically going to say, all right, our taxes payable is 168,000, and you're going to take the before tax cash flow and you are going to subtract out the 168,000 which is going to give you 832,000 as your after-tax cash flow. So in other words, the point is, you're not actually subtracting from your taxable income, because that, if you remember, what did I say about that? I said that is not a real number, okay? In the sense that that is simply a calculation for tax purposes. The real number is your before tax cash flow, or before tax levered cash flow as they call it, and that is, let's say, $1 million. And so from that $1 million, your tax liability or tax payable is going to be 168,000, and that is going to be based on taking your taxable income of 600,000, multiplying it by the appropriate tax rate to get that tax payable, and then you simply subtract the taxes payable from your actual before tax cash flow, and that gives you the 832,000 of after tax cash flow. Okay, does that make sense? Okay, now let's kind of clean a few little things up here. So that gets us through basically question 10. All right, so let's talk about the tax rate here for a second. There are multiple tax rates. You have a tax rate for ordinary income. You have a tax rate for capital gains. You have a tax rate for recaptured depreciation. Okay? Each one of those tax rates is different. Okay? Now, and they change. Those change more often, okay? They can change, every couple of years, those can change. And like, for example, like with the capital gains tax rate, if you take a look right now.
Excuse me, can you see what was the third one? Ordinary and capital gains?
Okay, the three different types of tax rates for real estate are ordinary cash flow, ordinary income, which is what this would be. Then you have capital gains tax rate, which is whenever you sell the property. Also, whenever you sell the property, you may have to pay what are referred to as recaptured depreciation. And whenever you do that, there is yet a third tax rate that gets applied. Okay? Now, normally, well, I say normally as in the most recent of contexts, the ordinary income tax rate is typically going to be the highest. Normally, the capital gains tax rate is going to be the lowest, with the recaptured depreciation somewhere usually in the middle. Does it have to be that way? No. That is simply how it has been structured. But depending on how the government chooses to change those tax rates, influences behavior of people and corporations very quickly. So, for example, if we were to Google right now, so you can hop online, those of you in Zoom land, and just simply type in 2020 capital gains tax rate. Just Google it. And you'll have a short-term capital gains tax rate and a long-term capital gains tax rate. I'm going to try to Google it here.
%, 15%, and 20%?
Okay, yep, basically depending on how long you hold on to the asset, you'll pay as much as 20% or 0 depending on the circumstances. So 20%, let's just go with that for a second. So basically what that would mean, if the capital gains tax rate were 20%, if you buy an asset for, let's say, $100,000, you sell it for twice that amount, you sell it for $200,000, then you would have a $100,000 gain, capital gain, barring any other circumstances, you would pay 20% of that, or $20,000 in capital gains tax on that sale. Does that make sense? Yes or no?
No. Well, that makes sense, but that makes sense, but I think we're looking at doesn't that go off the income, basically off of what you're making?
No. We're looking at, okay. Capital gains applies to whenever you sell the property. We're going to get into this later in the course, but I'm just going to kind of brush on it real quickly. So we buy it for $100,000. We sell it for $200,000. The gain,
$100,000.
the capital gain is $100,000. The capital gain tax rate is 20%. So we would have $20,000 in taxes payable on that sale.
As a seller.
As the seller of the property. Okay, now, that is as clean and pristine as it could get. It's pretty much never clean and pristine, okay? This would basically make the assumption, for the most part, this is raw land. You bought the raw piece of dirt for $100,000, you sell it for $200,000, simple capital gain, simple percentage, taxable income. How can I avoid or postpone having to pay this $20,000?
You can reinvest it.
By reinvesting the $100,000 and buying another property.
You can reinvest through
or 1030, or what is it?
a tax deferred 1031 exchange. And what that means is that you go out, you find a replacement property of, for the most part, equal or greater value, and you buy that property, and then you immediately put the proceeds from the sale of this original property into the new property. But here's the thing. It's not that simple. And when I say it's not that simple, is you, as the seller of the original property, can't touch these proceeds. In other words, like, for example, you do this transaction, and let's say that I'm the seller. I can't take that $100,000 and put it in my bank account if I'm going to go through with a tax-deferred 1031 exchange. What has to happen is that money stays, in essence, in escrow with a title company, and the title company keeps it in their possession while we do the deal to, in essence, find the replacement property. Then once the replacement property is found and purchased, then the title company uses those proceeds to then fund part or all of that purchase on the new property. If I don't do that, I'm going to be subject to that 20% capital gains tax. Does that make sense? Yes or no?
Sir, do you get your $100,000 back and then they can keep the $100,000, or
Never touch it.
they have to keep both? They have to keep the whole thing.
They keep everything. Everything. So in other words, the title company is going to keep the entire $200,000 from the transaction.
That doesn't make sense because your initial investment of 100,000 is tax paid.
No, it's not. They're going to have to keep the entire 200,000 from the sale because part of that is the gain. And that gain has to then be reinvested along with the original amount. Okay?
Gotcha.
Okay? So in other words, you've got to find a property for purchase that is valued at more than $200,000 in order to qualify for this. Now, here's the thing that you've got to put in your head. Why, first of all, does this even exist? The reason why this exists is because at some point, the regulators said, hey, we have people out there in industry that are, basically investing in real estate for their business or whatever it might be, and we don't want to penalize them every single time they choose to, quote unquote, upgrade the property that they own, okay? And so we are going to offer this as, in essence, an incentive to upgrade without having to pay the tax man. Okay, now, having just said that, there are all manner of restrictions. I oversimplified it, but all manner of restrictions as to precisely how long you have to find a replacement property, how long you have to close on a replacement property. And there's this whole thing of it needs to be, another key word here, like kind. And what that means is, for the most part, commercial property for commercial property, residential property for residential property, farm property for farm property, land for land, and it can get really confusing in some instances of what will qualify, what won't qualify. Then you have other complications of, well, what if the property has other things that contribute to its value that aren't necessarily real estate? So, for example, and I'm not trying to go down the rabbit hole here, but let's say that you buy this building, this classroom, okay? Think of this room as this being a building unto itself, okay? What are you really buying? Technically, you're buying the four walls, the ceiling, the windows, outer doors, all of that. But what else has value? Tables, chairs, computer equipment, all of that sort of stuff is not part of the real estate, okay? Unless it gets classified as a fixture. And that's yet another thing for your law class to go down the road on. If something is a fixture, that means it's, in essence, attached to the property in such a way that to remove it from the property would be destructive of the value in some significant way of the property and potentially of the fixture. So one could make the argument, like for example, one can make the argument like the projector that hangs here from the ceiling in the room. That is physically attached to the room. To remove it, yeah, would be complicated. So you can make the argument that is a fixture that goes with the real estate. But yet, the rollaway sort of big screen TV I got over here, that's not really attached to anything. You just unplug it from the wall, roll it out of the room, so that, and same thing with the desk. You could very easily move the desk and the chairs out of the room. My point is, as it relates to this example, technically, those things can complicate the transaction. Because if those things have a whole lot of worth to them, and like, for example, you're going from a $200,000 building to another, let's say, $200,000 building, being this room, but yet $10,000 of this room is made up of all this other stuff, that could potentially throw this transaction into partial jeopardy because those items would not be considered to be part of the real estate. Does that make sense? Okay? So, once again, our role here is not to go down the rabbit hole on all of that. That is a whole other situation. But my point is that, very simply, the capital gains tax rate matters. So, for example, one of the things that Congress constantly talks about is changing it, going one direction or the other, you know, raising it or lowering it, okay? If they lower the capital gains tax rate or do away with it altogether, as some countries have, then what does that do? That motivates people to sell property because they're saying, woohoo, I can cash in on all these investments that I bought that have gone up dramatically in value, and I can walk away with all that money sort of free and clear without having to pay tax on it. Okay? Now, if they raise the capital gains tax rate dramatically, then people are going to say, I may hold off on selling property. I may just want to own the property and manage the property because I'm going to lose so much of the value of the property if I choose to sell it. Does that make sense? Okay? On a very basic level. Now, back to our old example. This tax rate, as I have referred to it here, the marginal tax rate. This is applied to ordinary or operating income from a piece of real estate. So that the annual income that a property generates, this is typically, going to be a tax rate that's going to be applied to that. Now, this is just for this example. What we're going to find a little bit later in this course is that number is specifically different for different investors. For example, assume that you are an extremely high net worth individual and you've got a lot of income coming in from all different sources, not only from real estate, but from consulting activity, from whatever else, okay? You got a lot of money coming in the door. You are going to have a high marginal tax rate, meaning it could be as high as 39% or so of your income. Whereas, let's say I don't have any income. That I'm basically destitute. I'm out there on the street and I have virtually no income coming in whatsoever. My marginal tax rate is going to be super duper low. Might be 0, might be 10%. Okay, so that means that if we both own the same piece of real estate, you're going to be taxed much higher on your percentage ownership of that real estate than I am. Does that make sense? Okay? And so this is where that we get into the whole thing of partnerships and deal structures and ownership entities and basically pari passu distributions and all this other wonderful stuff that we'll be getting into a little bit later in the semester. But suffice it to say, the tax rates applied to ordinary income are going to be different for different investors. Okay? Does that make sense? Yes or no? All right. And the recaptured appreciation tax rate will also we'll deal with that a little bit later as well. Okay. All right. Any questions for any of the stuff we've covered today?
Just, I had one question with this 1031. When you said to reinvest, what, did you say the whole sales amount has to be reinvested, or and then the other one is that
everything?
So that means that the whole sales amount stays
Yes.
in escrow?
Yes.
So would that be an example of, let's say I have a property I rent out to a tenant and the income from that is going to be like the 28% at the end of the year for the tax income?
Yes. And so here's the thing. And one of the things that should, I know you're getting worn out, you know, head blown, all that sort of stuff, but one of the things that you should start to begin to think about is motivations. Why would you versus any of you or me make a decision about a property in one way or another? And many times those decisions are driven either exclusively or certainly partially by our particular tax-related issues, okay? That is what I'm saying that's so important. Because a lot of you just sort of sit out there or in here, wherever, and you sort of say, oh my God, this is so boring. This is so horrible. Why are we having to learn about this? Why are we getting into all this tax nonsense? Because of what I said earlier. If you take away a couple of little things from here that potentially either could save you a tremendous amount of money or make you a tremendous amount of money, simply because of understanding some of these little issues and nuances and implications of tax law. I'm not suggesting you become tax experts, but I mean, how many of you had any clue about most of this stuff before you walked in here today or sat in here today via the Zoom? You know, a few of you maybe, kind of, but for the most part, no, okay? And that's kind of my point. That's kind of the value of the whole degree program, is learning these things that hopefully you can put into practice in some way, all right? Now, so, other questions, comments, observations, whatever, about anything? Because I've got a couple of things I want to talk about and then we'll be done. Nobody?
So we'll go over capital gains in another class.
Yep, we will. We will. Later in the semester, trust me. I promise you, in fact. Okay?
Okay.
All right? All right, any other? Okay. You don't have to, but I would really appreciate it if everybody could put their cameras on, because what we're going to talk about now does involve you, specifically. So, all right.
Maybe he's at work.
Maybe.
Okay. So one of the things that some of you may already be involved with, some of you are brand new or have no clue about, some of you are wondering about, some, everybody kind of is maybe at a different point in stage depending on where they are and when they started the program and that sort of thing. But one of the things we want to talk about today is our mentorship program, and specifically what the next steps are for you if you're interested. This is an optional thing for the program. It's something that I think has potentially has a tremendous amount of value, but it's like a lot of things. You know, it's like you think about the effort that you put into a class. You get out of it kind of what you put into it. Same sort of thing is true with kind of this mentorship program. That if you take a look at our website, the nova.edu/real estate, and you sort of scroll down, and there's a section there on advisory board. There's, I don't know how many people now, we've got 15 plus advisory board members, and a handful of others that serve at no cost to any of us as mentors and advisors to not only the program as a whole, and many of them over the course of the program will come in as guest speakers, guest lecturers, that sort of thing. They also, in certain courses, certainly on the final capstone project, serve as judges, outside judges for those projects, but also they play yet another role for you to the extent that you're interested and you want to take advantage of it, and that is as potential mentors. Now, historically, pre-COVID, the way that we approached the mentorship program is we would typically have an event, a face-to-face event, some sort of maybe a networking event, that sort of thing. We would invite basically the advisory board, we would invite the students, we'd have a mix and mingle kind of cocktail party, and people would kind of be, the students would be given their, an option to pick their top, 2 or 3 choices for mentors. And then I would go through, compile basically this list of, okay, this person wants this person as their mentor, and here are their choices, and then kind of go through and then ultimately make these assignments to where then from that point forward you'd be matched up with this mentor, and you would typically get together as often as either of you or both of you were kind of in agreement. Sometimes it would take the form of, a phone call every week or 2. Sometimes it would be meet for breakfast, meet for lunch, meet for drinks. Sometimes it would be a situation of where you'd go hang out at their office for, a day or 2 and kind of shadow them. Every relationship in the program was different, okay? But once again, it was that whole thing that if the mentor thought you were really into the arrangement of being involved in this, then, they're going to be more interested in obviously spending more time and getting to know and help you and kind of your career aspirations. Now, here's kind of what the mentorship program is and what it is not. What it is and what it's meant to be, it's an opportunity for you to have one-on-one interaction with someone that's been in the industry for a number of years, and that person can give you insights about how you may be able to progress from where you are now to potentially where you think you want to be, and maybe even in some cases help you figure out where you want to be. And through mutual kind of sharing of information, maybe a situation of where they're able to, if nothing else, make an introduction. Like, for example, you get paired with a mentor, and that mentor in and of themselves can't really help you in the sense that, let's say that you want to go into, I don't know, developing high-rise office buildings. All right, but this mentor maybe is focused on developing low-rise townhomes, okay? They may not be the person that is the best fit for you in one sense, but chances are they know a lot of people that they can put you potentially in contact with that would have that more focused, aspect of what it is that you might want to do. So they can potentially open doors, is my point. Now, what the mentor is not. The mentor is not someone that, in essence, is there to help you get a job. And what I mean by that is, you never, ever, ever would say to the mentor, hey, can you help me out and get a job? Can I, give you my resume? Will you pass it around to, some people you know and see if you can... No, 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 no. That is not the role of the mentor, okay? The role of the mentor, they may look at your resume, they may give you advice about your resume, but their role, unless they choose to do so, is not to pass around your resume to everybody and to offer up, opportunities employment-wise to you. Now, sometimes it happens, but that is not meant to be their role. You follow? Okay? Now, once again, everybody's relationship with their mentor is different in terms of how strong the relationship is or how involved it is and so forth. But a lot of that hangs on you. Now, what I will say, for the past 7 years or so that I have been here and have been running this program and dealing with the mentor program as well, I would say and once again, this is not like a hard and fast number, but I would say 25%, probably a fourth of the mentor-mentee relationships truly blossom into something special, okay? In the sense of they, from the moment they meet, they have kept in contact from the moment they've met, even well after they finish the program, okay? And I would say probably another, let's say 25%, they've met, they've interacted, they've had some good conversations, there's, hopefully something of value that comes, from the relationship. And then, probably another 25%, they meet once, maybe twice, that's it. And then there's 25% of folks that they maybe never even meet, and the reason they meet is not because of the mentor, but usually because the student doesn't take action. Because what will happen is, like for example, you give me your top 3 choices, you give me your top 3 choices, you give me your top 3 choices, all of you give me your top 3 choices. What I will do, as I said, I will put that into kind of a spreadsheet, kind of look and see what makes potential sense, and then once I have a chance to do that, then I make the assignment, so I say, okay, you're going to go with Harry Posen, okay, who happens to be developer of townhomes and that sort of thing, serves as the chair of our advisory board, wonderful guy, and he's going to be your mentor. And I'm going to send you an email, okay? Harry, here is your information. Here, you are going to, then provide him probably with a copy of your resume, and I'm going to provide you with this sort of mentor-mentee handbook and kind of some of the things I've been talking about, the do's and the don'ts and whatever. Then it's going to be on you to follow up and sort of email or call Harry and say, hey, when can we get together? And then he responds back, okay, here's when and how and all that sort of thing. And then, you get together. But if you don't take the steps to actually, keep this relationship going, chances are Harry's not going to keep that relationship open, okay? He's going to say, okay, you're just wasting my time in the sense that you're not really engaged in this process, okay? Does that make sense? All right? Now, what we don't do, as a general rule, unless there's some horrible, crazy, bizarre circumstance, you have one mentor, you don't get to hop around between mentors. Doesn't mean you can't have a phone conversation or an interaction with somebody, but the point being is, if your assigned mentor is Harry Posen, that's your mentor, okay? It's not Tony Trella or whoever, okay? Or Gloria Fernandez or Debbie Rashevsky or whoever. So my point is, you need to take it seriously if you want to, okay? And if you want to get involved in this, but once again, number 1, does not impact your grade in any course in any way, whether you get involved with the mentorship program or you don't, okay? So right off the bat, you're saying, oh, is this extra credit? No, it has nothing to do with any sort of a course grade. This is about your professional development, okay? So, but what I would say to you is, if you're interested, you need to get involved with your mentor. If you're not, then don't bother, okay? So now you're going to be saying, okay, what are the next steps? All right? So the way we have tended to work this in the past on purpose is, number 1, you have to be in good academic standing. And what that means is you've got to have a current GPA in the program with having completed 6 credits of a 3.0 or higher. Okay? So if you've only completed 3 credits, you're not eligible. If you've completed 6 credits or more with a GPA of 3.0 or higher, you are eligible. And the reason why we do that is, for example, and I don't want to get too in the weeds and specific, but like with the courses we just completed, like with the real estate finance course and the GIS course, there were several people that failed those courses, okay? Or made low grades in those courses. And so those people may or may not be successful in the program, you know, long term. And therefore, you know, if they can survive the program in terms of getting their GPA up to a 3.0 and be eligible, that's wonderful. But until they do, they're not eligible, okay? And so we want to ensure that someone's going to be successful in the program. And so the demonstration of that, if you will, is to get through 6 credits with a GPA of basically 3.0 or higher. Okay, does that make sense, everybody? So, those of you that are eligible, now here's the thing. Some of you just started the program this semester, okay? In other words, you have no credits. Well, you would be eligible if you completed 6 credits after this semester, then you would be eligible immediately in December after this term ends. Does that make sense? Assuming you have a 3.0 or higher, okay? Now, those of you that may have been in the program for a couple of semesters because of just kind of randomly dropping in the program at one point in time or another, then if you, once again, if you have your 6 credits done, then you're now eligible, we can move forward. Okay, so what do you do? And this is where, once again, I'm not going to send you a bunch of emails about this, okay? And this is basically the conversation we're having right now. So if you're interested and you qualify, all you have to do is send me an email and say, Professor Werge, hey, I want to join the mentorship program. Here, looking at the list of, you know, mentors, here's who I might pick or potentially pick. There's a little bios for each of them there on the website. And if none of them seem to float your boat in some way or another, then give me a description of what you might be interested in terms of, you know, career direction or career path, and I can help make the decision, you know, for you, okay, or potentially find somebody else for you. But this is the kind of the part of the program that, as I said, I'm not going to send out a bunch of emails saying, please, please, please do this. My approach is, I'm telling you about it, I'm explaining it to you. Now you've got to take the personal responsibility to, in essence, basically get in contact with me to say, hey, I'm interested in this. Yes, I qualify. Here's who I'm interested in. Let's move to the next steps on this. Does that make sense, everybody? Yes or no? Okay. All right. Any questions from anyone on that? Okay. All right. Well, it is now 11:01. Once again, this quiz will be up and posted, or it is ready to go at 11:15 today. So just like last week, you've got until Monday night to finish it. And the scores on this quiz actually were really good. I think, as I said, I think about 6 people or so got a perfect score. So those of you that did not get close to a perfect score, you know, what I'm going to be doing is I will go ahead and probably send out the solutions to each of those quiz questions, as I will do probably each week. But I don't like to do that until the quiz is completely done, everybody's taken it, all that sort of stuff. But you should be able to look in Canvas and see not a solution, but you can see what the answer was for each question now, okay, for this past week's quiz. That has been unlocked. And I usually unlock it sometime on, you know, Tuesday or Wednesday so that you can kind of look back and sort of see it, okay? All right, any questions, comments, observations? Yep.
3 names, right? You said 3?
Yep, 3 names on the mentor. If and I mean, there's no absolute guarantee, but you know, because here's what usually happens is there are a lot of people that will pick the same exact persons over and over again, and not for any good reason other than whether it's name identification or you know, what their particular interest is. And we'll try to. And some of the mentors take on more than one student each year. But you know, they have committed to take on at least one. Now, also one other obvious piece in this, in the midst of this whole pandemic, I don't know what your mentor is going to be up for, you know, in terms of meeting in person, you know, socially distanced, or whether it's going to be a pure Zoom relationship. I don't know. You know, maybe you guys can, you know, sit around on Zoom and have happy hour together. I don't know. But you know, figure it out. That'll be, once again, up to you and your mentor, okay? All right? One other thing that just rolled across my desk is a couple of our graduates, Stephen Blosh and Noah Leon, started a company called Defined Companies a couple of years ago. And they are doing predominantly multifamily residential redevelopment and new construction. And they've actually want to have us out at their newest project, Palmaire. And normally we like to do field trips. Well, they do have an open house that's sort of coming up. I think it's Tuesday, November the 11th, around 12:30. And I'm sure they would more than welcome, you know, other folks to show up to that grand opening. But they also have made it very, 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 very clear that they are very open in having, obviously, a more narrowly focused site tour with the students, because the open house thing is going to be a bit more, what's the word I'm looking for, cosmetic and probably non-substantive, in the sense that you're going to walk around the property and you're going to look at the property and you're going to get a little bit of an explanation. What we like to do in our site visits is not that. What we like to do in our site visits is to have a more kind of intimate sort of you know, circle of trust, in the sense of getting the developers, getting the students kind of in the same room at the same time, and really delve into the details of the project. You know, how did they get the project financed? Who were their equity partners? You know, how long did it take? What sort of issues did they face with the local government in getting it permitted and approved? What were the challenges in potentially getting it either sold or pre-leased? What are the challenges maybe associated with management? You know, getting into the weeds of the operations and the process associated with getting through with the development. So, you know, the open house thing is kind of a fun thing to go and, you know, have some hors d'oeuvres and, you know, whatever, but the more substantive thing is to actually have a site visit. So, I'm going to probably send an email out on this one to all of you, both in this class and as well as others that are currently in other classes within the program, and, you know, and say, look, we want to put maybe something together, and it would be, you know, probably an hour, hour and a half on site at their project. Once again, socially distanced, masked, all that other sort of hoopla. But my question to you, and I know what your answer is going to be before I ask it, but when would be the best time to do it? Now, your answer that I know is going to be the answer is more than likely, oh, let's do it on Saturday during class time. No, we're not going to do that, because class time is way too precious for us to use. Now, what we can do is potentially after the day is done, so like at 4:30 in the afternoon, after you're done with all the classes for the day, you know, you hop in your car, drive over to the property, maybe have a couple of beverages or something, and then, you know, talk, listen, learn, and then, you know, by 7 o'clock at night, you're sort of done, back home, that sort of thing. Does that make sense? So, I mean, now, if you want to do it at another time during the week, like for example, you want to do it, I don't know, you know, on an evening, you know, after work, that's potentially fine, but, you know, we get too late in the evening, it's going to be dark. So, now, of course, some of you that know me well enough to know, I'm the morning person, so I would be totally up for, you know, 5, 6 o'clock in the morning site visit, but not too many other people would, okay? Probably including Steve and Noah. But, you know, that would be sort of my preference. But, in any event, I'll be sending out an email, probably do some sort of like a doodle poll thing and sort of saying, look, if you're interested, sign up on the doodle poll, pick your available times from these times, and then based on that, then we'll try to see if we can set something up with a site visit for them. And once again, if it's only a half a dozen of us, that's fine. But I'd rather it be a half a dozen of you that are genuinely interested in learning more about it than to have 30 or 40 people showing up, only of which 5 or 6 are interested, okay? So, you know, this is why it's not extra credit, it's not part of your grade, you know, that sort of thing. It's a totally independent, outside of class, you know, sort of thing, okay? Okay, any questions, thoughts, observations?
Question.
Oh, yeah, no, the question from Hannah, can we still do the site visit? Absolutely. Doesn't matter whether you're brand new to the program, that has nothing to do with the mentorship program. So totally separate thing. Okay, question from somebody else?
Yeah, I have a question. The mentorship program, you said to find out who's mentoring, you go where on the website?
Just go underneath advisory board.
Advisory board? And the main, and our main master's program, real estate, right?
Nova.edu/real estate.
All right, that's what I did. All right, no problem.
Okay, anybody else?
Okay.
So we can have you.
What?
You're one of them.
Yeah, I'm a horrible mentor. So, you know, potentially, yeah, pick somebody else that is much more interesting than me. Okay? All right. Anybody else? Any other questions, observations?
Dr. Forget, is the mentorship program, like the questions that you ask, purely related to just our curriculum, or can it be outside? Let's say, for instance, if I was looking to develop a property or something like that.
Well, okay, once again, it's you're not going to go into these mentors and say, hey, I'm about to do a development deal. You guys want to be financial partners? No. No, 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 no. That's not going to be the case. But if it's the sort of thing that you're like, hey, I'm wanting to do a development deal, can you give me some advice on how I might go about trying to find financing or something like that? Yeah, you can ask that. Okay?
Thank you.
In other words, don't ask the mentors uncomfortable questions. You know, it's kind of one of those things that, you know, back in probably elementary school, you had guest speakers come in, and invariably somebody would always ask, how much money do you make? You know, don't ask questions like that. You know, ask, you know, the kinds of questions that obviously, you know, are going to be insightful and hopefully demonstrate. Because here's the, okay, let me back the train up just a little bit, because I didn't say this earlier. Without question, the mentors are judging you every step of the way. Okay? Everything that you do, everything that you say, everything that you write, every word that you use with them, they are judging you. Okay? And what I mean by that is, after interacting with you for a set amount of time, they're going to say, wow, she is amazing. She is right on point. She knows what she's doing. She is going to absolutely be a rock star. I'm going to make sure that I help her do that. Okay? Or they're going to say, he's a total dud. You know, has nothing going for him, not somebody I want to basically spend a lot of time dealing with, and, you know, has very little to offer the world. Okay? Those are two extremes, but you get the idea that what you say to these folks and how you interact with them is going to have a super big impact on how they deal with you. Okay? That's what I'm saying. And I mean that in a positive way. So, you know, just basically be on your best behavior. Okay? That's, you know.
It's like your date.
What?
It's like the first date.
Yeah, sort of. I would not want to put it in that context, because then that tends to, you know, make things a little bit more whatever, but no. Okay, all right, anything else? We're done? Other questions? Okay, see you guys next week.
Thank you.
Yep.
So what's our, the email you sent has nothing to do with students for that meeting, right?
I'm sorry?
The board meeting that you.
No, that's just for you, Max.
Oh, okay.
Because you're working as our graduate assistant.
Okay, so it's got nothing to do with this. Okay.
Yep.
Dr. Forky, can you help me really quick with the two things I didn't understand last week.
Okay,
The calculation. I feel like if I'm here, it's easier for me to understand.
all right, shut this down here.
So regarding my question with the 3 classes before, I haven't finished another class, I don't even need to check.
I'm sorry, what? I'm sorry.
Like I said, I'm only doing 3 classes instead of 5 classes this semester. So before I haven't finished another one, I don't even need to,
Okay, yep.
correct?
So at the end of the semester then?
Yeah.
Am I allowed to be mentored by somebody I already know?
Yeah, it's, I mean,
Like,
well, I mean,
Jessica, I've asked
look,
for Jessica
our-
or Ken to be my a mentor, but I've already worked for them.
No,
Like,
I-
Jessica got me the job.
Right, no, and that's fine, it's just, it's all about what you're trying to accomplish.
Well, there's that guy
Then
Cody
you're not
Graham
networking.
at EDSA, and they do hotel